The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and we're in the thick of it right now. I'll tell you, many of your forms, if not most of your forms, are coming in this week, and we certainly want to help you. We certainly want to make sure that you don't overpay your taxes. And so I'm joined in studio with Christopher Fabian. Hey, Chris.
Hello, Esther.
So, and Tiff is back at the ranch doing tax returns, right?
Correct.
Okay. And if you're somebody that has any questions, we'd love to help you. 803-0930, 803-0930, star 930 on a cell phone. You can text us at 716-803-0930. And for those of you that are in Florida and you'd like to ask tax questions, you can go to our website at EG Tax, Ask the Tax Lady, and you can ask your questions, and we'll answer them right away. And we love helping people, right?
That's right. That's why we do what we do.
That's what we do, right. And so I'm Esther Gulius, the Tax Lady from EG Tax. All of our offices are open 9 to 9 Monday through Friday, 9 to 9 on this upcoming Saturday. We're closed on Sunday except for the McKinley Mall.
Right. So we're there for you in your backyard whenever you need us. We're there.
That's for sure. Okay, so wanted to talk, and again, 803-0930, 803-0930, star 930 on a cell phone, 716-803-0930 is our text line. So I want you to realize that so much of taxes, you can manipulate legally your refund many times by using IRAs and something called the Earned Income Credit. So one of the things that I find that's very important is when parents of children, the custodial parent has the right to claim the children, but many times it would be better for the non-custodial parent to claim the children because of things like the child tax credit, because mom, who has the custody of the kids, can still get the Earned Income Credit if she works, and dad then could get the child tax credit, and it may work out the best for the family if the family is able to talk about it. Right?
You have open line of communication to help.
Right, because I will tell you, sometimes dad is the one who made the wages, and mom might have been staying home with the kids, and so he would qualify for the child tax credit and the refundable child tax credit, whereas mom wouldn't if she had no wages.
Right.
So that's one thing. If you're in the midst, or if you have kids that are in the midst of a divorce, if they can get to the place where they can talk to each other, the family, even though they're not living together, can really benefit.
Right.
That's
right.
Let's say you have kids and no wages and low income. What would be something that person would want to do?
So they have
minor children.
Yep.
And they have wages, but they have no income. They might just be living on child support.
Right.
Or alimony.
But they have no wages, so they would want to get a job.
Because why?
Because then they would get the Earned Income Credit and the additional child tax credit.
Right, and the thing is, they would get a refund if they're at the optimum with the Earned Income Credit on the federal, refundable child tax credit on the federal, and on the state of New York, they also kick in. This family would be looking at like an extra $10,000 to $12,000.
Yeah.
Just because she got a job, right?
Yeah. So, make $10,000, you get $10,000 back.
Absolutely. And so you've just doubled your income.
Yeah.
And realize that if you have a recent divorce and you are getting spousal support, the spousal support is tax-free. And the payer, which used to be known kind of as alimony, the payer doesn't get to deduct it unless you are a New York resident.
Right. New York, you get to take it off. But on federal, no, not
Right.
anymore.
Right. And on New York, even though it's tax-free on the federal, it's taxable on New York State. Right? Well, let's go to our phones and we're going to talk to Jerry. Hey, Jerry, this is Esther Gullius. How can we help you?
Hi, Esther. I was curious too. We got a lot of, or quite a big amount of revenue from IRAs and stuff this year, and I was wondering what can I give to my children to try to avoid some of that tax.
All right. Well, first of all, if you take money out of your IRA, it's going to be taxable to you.
No. I'm not taking it out of my IRA. I'm talking about the money that I received from CDs that I had.
Oh, okay. So you're saying that you got a lot of income from your IRAs and you want to pass it on to your children, and you're wondering
Right.
how much you can gift to them and have it be deductible. Is that what you're saying?
Right,
Okay.
exactly.
Well, any gift that you give, unless it goes to a qualified charity, is not deductible to you. It's not taxable to them, but it's not deductible to you. So unfortunately, even though you can gift $18,000 to your kids and you didn't have to do a gift tax return, that is a non-deductible gift that you're giving, and so it won't save you any money at all. The only way you could reduce your taxable income would be to give it to a charity, and quite frankly, the year is already over, so there's not much you can do. Did you work? Did you
No.
work this year?
No.
You didn't work.
No.
Okay, so that's about it. Really, what you need to do, you need to sit down and plan now for next year, for 2025. But again, gifting money to your kids is not taxable to your kids, not deductible to you. Right, Chris?
Right. What is your income? Where's your income sources for?
Well, I'm a disabled vet, and I have some retirement from
Military?
Bethlehem Steel and Teamsters and a company that I work for.
Okay, so obviously, if you have VA benefits, those are tax-free. Your
Right.
Social Security may be partially taxable. Are you getting Social Security?
Yes.
Yeah, and so, and again, I know that Trump is talking about going to Congress to have that repealed, so that may be a happy day for you for next year. But unfortunately, what you called about is we're not going to be able to help you with that, Jerry, because it's not deductible when you give a
Okay.
gift to
Thank you for your
to a
information.
non-charity.
Thank you very
Thank you
much.
for calling.
Thank you.
Okay.
All right. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Let's go to Daryl. Hi, Daryl. How can we help you, sir?
Hello. I looked at my federal withholding for the end of the year, and it was really low. And in fact, it was actually the amount that I had said extra federal withholding
Oh,
done
oh.
biweekly. So then I called HR in an alternative universe, and what they said was, you earn about $1,100 biweekly, and at that amount, we just don't take out any federal tax. So my question is that how it works? Because if that's so, then it's on me, because I should have checked the figures far earlier, than the end of the year to see that. Or is that just their company policy?
Yeah, no, unfortunately, payroll only looks at your paycheck for that pay period to calculate out the withholdings. So that's where these new W-4s have all those extra worksheets on them to say, do you have any other income, any other job? And then you use the chart and you got to say, okay, come up with all this extra money to do withholdings, because otherwise you'll be very limited in your withholding. So you are smart to do that extra withholding because you had some. But yeah, if you want more, you're going to have to tell them take more out each paycheck.
But he's
Okay, so
saying
they're
that
simply
they won't do it.
No, he's saying they won't do any normal withholding. They're only
Oh.
taking out as extra.
Well, then you have to do extra.
Yeah.
Right, and I
Or
I
I'll
did a
tell you
little
another
extra.
thing you can another thing you can do, Daryl, to make it maybe just simpler. Keep everything at your employer the same and set up estimated payments April 15, June 15th, September 15th, and January 15th of next year. Then you control the withholding.
Oh, all right,
So
all
if you
right,
need help with that, just let us know. We'll send you out the vouchers.
okay. With these new W-4s, basically, I got to take more active role in making sure things are taken out.
Right. I mean, everybody does. Everybody should watch their withholding. And it makes it very difficult with electronics because you get the direct deposit, and many times you don't even look at your backup documentation.
Yeah, exactly. Yeah, you got to look at. I saw if tax was coming out, but I did not even look at the figure, and
Sure.
so now I'm educated, I guess, in that regard.
Thanks for calling, Daryl.
Thank you, everyone. I appreciate it. Take care.
Have a
Thank
good
you.
weekend.
I'm Esther Gilius, the tax lady from EG Tax. We're going to take a short break. We'll be back on the other side with Kathy, Tiffany, and your questions. Hey, to us, you are family. I'm Esther Gilius, the tax lady from EG Tax. All of our offices are open everywhere, 9 to 9, Monday through Friday. We're actually going to be open next Saturday, 9 to 9. If you need the best tax help, you can call EG Tax at 632-7886. Visit our website at egtax.com. And you can also go to Ask the Tax Lady, and I'll answer your tax questions by text. Right, Chris?
That's right.
Okay, let's go to Kathy from Hamburg. Hi, Kathy. How can we help you?
Hi. So, hi there. Just to kind of
Hi there.
reiterate on the child credit. So, my daughter and her boyfriend, they have a child, and they're both disabled vets living on their military pension.
Sure.
At this point, does it even matter who claims the child? She does, but does it even matter who does?
So that's her only source of income?
Her only source of income. He just recently bought a franchise, but he's not generating revenue on it yet.
All right. So what they want, their goal ought to be, and I understand and I thank them for their service, their goal
Thank
ought to
you.
be to maximize the best that they can do with the tax code. And with a child, and all they have to have is earned income. So with his franchise, he could hire her and put her on the payroll, and she would have earned income. And then as their income begins to grow, because let's face it, a brand new company is not going to generate a lot of income, she'll get an earned income credit. They're going to pay her because she has a child living in her home. And she would get an earned income credit. Now, if they live together in the home, then
No.
the higher of the two, because they're both the parents of that one child, correct?
Correct.
So then the higher wage earner would be the one that would claim the child if they both live
Okay.
together in the same house. But that's
Okay.
something that ability to go out and make some income is a great way to come up with a bunch of extra money, and it's absolutely legal, and it's the federal government's reward for them going out and working.
Yeah.
Now, they don't
Okay.
happen to live with you, do they, Kathy?
No, thank God.
Okay.
Yeah.
Because
Yeah.
many times this situation is where you have two parents that are living together with their baby in grandma's house, and grandma might be working.
No.
And if that was the case, then grandma could get the earned income credit if they allowed her to claim the child. So there's so many angles that you can work on that are absolutely legal, and they result in a lot of extra money to the taxpayer. But I would encourage your daughter or your future son-in-law to go get some earned income, and it'll make the situation much better for them financially, because it's basically free money.
Yeah.
And I know there's no such thing as free money, but
I know.
in the tax code, that's how they have it worded.
Understood.
Okay,
I
Kath?
also have a weird off comment. So I'm actually HR for my company's employees, 70. We have 70 employees, and I have a ton of employees that take this extra deduction, state and federal, because they always owe or get close to owing. And I actually kind of do the opposite of what you said. I encourage them to take a small amount because we're paid weekly, we're manufacturing. So I encourage them to take a portion out weekly and in their direct deposit, do that into a credit union so they can separate their direct deposit, like 80% of one check or 80% of the check in one account and then like some into the credit union so that when they owe at the end of the year, at least they've earned some interest on that money.
Okay, that may be true, but they're also going to be penalized. You cannot owe if that's the case. If they really end up being behind the eight ball, if you owe more than $1,000 or you haven't paid at least as much into your withholding as your liability was the previous year, the federal government penalizes you for owing money. So I would really hesitate doing that as a suggestion to your staff because the truth is they could be penalized.
And they got to
what
be
if they pay it by the 15th?
You cannot. It's a pay-as-you-go system. As you earn it, you have to pay it. If you don't pay it and you owe more than $1,000, you're going to be penalized.
Okay. All right.
Okay.
Thank you.
Thank you, dear. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. All right, so we probably have seniors that are listening, right?
Yep.
Seniors that are working could get an earned income credit.
If they're under 65, I mean, that's not...
Right. If they're under 65, they can get it. And so let's say that you retired while you're 58, you got a little part-time job in the summer mowing lawns or whatever, and your paycheck is $15,000, you're single, and you think, oh, I don't get the earned income credit. But if you put $5,000 into your IRA, that would reduce you down to $10,000, and you would get a $632 earned income credit. So, and you have till April the 15th to do that.
Right.
So that's just a little tip for seniors that are under the age of 65 and still working.
Right.
Right?
So.
Okay, and let's go to Tiffany. Tiffany, how can we help you?
Hey, hi guys. You're very familiar with me.
That's a very familiar voice.
Yeah, I went to Buzz, Chris, or Esther and asked a tax question. I'm with a client, and you guys were on the show, so I just thought I'm here with them. We'd call. So she's wondering, Kathy Hochul, she said, was going to raise the child tax credit. And I said, no, I don't think so. I think what you heard is she's thinking of mailing out some checks for families. Do you guys, am I correct? She's not raising the child tax credit?
No, she's not raising it. She mailed a little check to people last summer. I mean, I had somebody today, they got $78. They're like, woo, we could go somewhere.
Oh.
Not very far.
Okay.
But the child tax credit's staying the same. There may be another check, not for children, but for singles or people with children, families, coming out in October or November of 2025, but there's still no details on that yet. So Don't count those chickens.
Right.
Okay. Thanks, you guys.
Okay,
I appreciate
thank you, Tiffany. It's interesting. We see on the board Tiffany from Tonawanda. We said, gee, could that be our Tiffany?
Yeah.
That is our Tiffany. All right. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930, or you can go to Ask the Tax Lady at our website. Yes,
Right.
sir.
I just want to go back to Kathy's call. If you're disciplined and you can set aside that money, that's, if you're okay with the little penalty because you're getting interest, that's fine. But how many of our clients do we see?
Well, there's that. I mean, first of all, they would get penalized. That's
Right.
the number
If
one.
the 1,000,
number
yes.
two, it really is against the IRS's regs. But number three, interest rates are dropping. I know Donald Trump wanted them to drop a lot more, and it didn't happen. But interest rates are dropping. So if you're getting 2% and they're charging you how much?
5%.
5%. That's not a good deal. And more than anything, with Kathy, you got to really be careful because you don't want to steer people down the wrong
Right.
road. And I know her heart's in the right place.
Yes.
Right. All right. So let's go to Larry. Hey, Larry, how can we help you?
Hey, good afternoon. I'm self-employed, and my business has been very, very good to me.
Good
So
for you.
I make charitable deductions of about $1,100 a month.
Okay.
And I got to thinking about it, so I started taking $1,100 a month out of my SEP IRA, and then the cash that I normally would make the deductions with, I put back into a Roth IRA, basically doing a conversion without paying tax. But I got and they send the checks to me made out to the charities. This is from Vanguard. And when I got my 1099-R this year from my SEP, they showed that I had a distribution of $7,000. And I didn't receive $7,000. So how do I show my tax preparer that
Well, you got to
I
tell
didn't
them.
receive that money?
Yep, you got to tell them out of that 7,000 how much went directly
To the
to a
charity.
charity, and they should know how to do it on their system. They have to record it as a qualified charitable distribution and not have you count it as income on the tax return.
Okay, so I just need to, like the year-end
You need to
statement
let
from the charities.
you need to have your tax accountant know that that was a qualified charitable deduction.
Okay. All right, thank
Okay.
you.
Thank you. Hey, I'm Esther Gillius, the tax lady from EG Tax. We have 31 area offices. We have offices in Florida and Arizona. If you're listening in Florida, our office is on Airport Pulling in Naples, right across the street from Tamiami Ford. All of our other offices in upstate New York are all around everywhere, right?
Can't hide from us.
That's right. All right, we're going to take a short break for the news. We'll be back on the other side. Hey, family, this is Esther Golias, the tax lady from EG Tax. It is tax time, and we want to make sure that you don't overpay. We want to make sure that you get every deduction that you're entitled to, every credit. A credit is a lot better than a deduction, and we just want to help. And I will tell you, if you have questions, you can call us at our corporate headquarters, at any of our branch offices, and we want to help. This is our very busy time, but we certainly want to help you. I wanted to mention that I had a client the other day who said, I'm just so frustrated. I seem to be making too much money to get any kind of a credit or deduction. And that kind of is true, isn't it, Chris?
Yeah, there is income limits to a lot of credits.
A lot of credits. So I said to him, basically, he and his wife collectively did about $4,000 a piece into their 401k. So I said, basically the only thing that you can do is hide your money from your W-2. And he said, oh, that sounds illegal. And I said, no, put more money into your 401k plan. And basically what I was saying to him is right now they put in 8, but if they contributed an extra $23,000 apiece and they had the money, and they could use the catch-up of the other 75 catch-up provision, not catch-up, they would save $24,400 in taxes by just funding their IRAs at the maximum that they could. So that's about the only game in town for them.
Yeah.
Right? Unless they actively went out and bought a business.
Right.
And as they start up the business, it usually throws some losses, or they had stock losses. But the thing is, when you're at that high tax bracket, even though, now what do you think about all the politicians that say that there is all these loopholes for rich people? Do you think that's true?
Well, they're there for everybody. I mean, that's it's
but
not
when
the
you're-
politicians.
But when
Well,
you're rich,
one side
right?
says
When you're rich,
yeah.
you're phased out.
Everybody says the rich, they pay no taxes. Yes, they do. They pay
pay a lot.
different. They pay a lot of taxes. They may pay different taxes than what we're used
Right.
to, but they are still paying their majority of their money in taxes.
Right.
Because if there was a way to avoid paying taxes, let me tell you, I think I know somebody who would. You.
Oh, me. Yeah.
but no, they're going to pay.
But utilizing your pension
Utilizing-
is absolutely a great way, because not only does the money go into your own pension plan, but you also save a lot of money in taxes. And so that's a really important thing to think about, and when you're doing your tax planning, because you get completely phased out of other credits and deductions as your income goes up.
Right. And, and I know a lot of people, well, that's because they make all this money. They can afford to do it. But if you start off, like our gentleman here, he's very young at our board. If he started off putting money into his 401k now, he starts at 5%, and every year he goes up a percentage. That would be a lot of money that he would have when he's retired, and he wouldn't miss it every paycheck because he's not used to it.
He's not used to it, right.
So,
and every time somebody gets a hit, they're moving up the ladder, take some of that money and put it away.
Yep.
Because you really do want to save for retirement for two ways. You can reduce your liability and save for the future. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. All right, we want to talk about the 229, right?
Yeah, we got, someone just said, could you please talk about the property tax credit
Yep.
and what it is called, who qualifies, and what years?
All right, well, the property tax credit went away in 2024, but it is live in 21, 22, and 23. So if you're somebody that paid property taxes in New York, I can better say New York because I got people listening in Florida. If you paid property taxes in the state of New York and your income was relatively modest, and actually could add a little bit more income, then they would have given you a credit if you qualified. There's a math computation between $250 to $350 refundable credit. And even if you didn't have to file a return because you had no income, but you're paying the property taxes, you would still qualify for that. And you can go back and do 21, 22, and 23. If you just did the returns and left them off, you can amend the returns and they'll give you the money.
All right. Yes.
So
And
that's IT 229.
right. And then speaking of New York, someone was listening to Tiffany when she called in with her question. She said, Hochul did put out there that she wants to increase the child tax credit only for children up to 4 years old, and then there's $1,000 for 0 to 4, and then $500 for other kids, but it's got to get passed on April 1st.
Well, there you go.
So, but Kathy has been talking a lot lately.
Well, yeah. I mean, obviously, up to 4 years old, that's when if your mom and dad are both working and you're paying daycare. I mean, daycare is, I had a client today, they paid $9,400 in daycare, and this was for a half a year. And how much can they take on the federal? Just one kid.
$3,000. Which would give them a $600
right. So
credit.
I understand where Hochul's coming from about the 1 to 4 year olds, because that's before they can go into preschool. They could actually go into the early kindergarten,
Right.
Also wanted to say, if you have kids in college, the 1098-T form, we talk about this all the time, comes in the kid's name. But the 1098-T form is for children that are in the first 4 years of, well, actually, it's for anybody that's in higher education, but children in the first 4 years of higher education can get a refund up to $2,500 on the federal. Actually, it's tax reduction credit. And on the state of New York, you also could qualify for another credit or itemized deduction. It is a big deal. And so if you have children, and even if they borrowed the money to pay for the education, it's almost always, there is an exception every once in a while where the kid, maybe the parents don't have any income and the kid is working on their own. But basically, it does the family better to have the education credit claimed by mom and dad.
Right, definitely.
And that's called an AOTC, American Opportunity Tax Credit,
yes.
on both federal and state. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. But that AOTC is so much money. And you know, in the year that a child turns 17, what happens to mom and dad?
Their child credit goes from $2,000 to $500.
Right.
So
And
they lose
but-
$1,500.
Right. Now, then next year, if the kid goes to college, then they kind of recoup back what they lost because of the AOTC,
Right.
maybe. But if the kid doesn't go to college, that's the way it goes. Oh, wait, we got another text here.
Yep. Would you suggest people fund a mix of a Roth and traditional retirement accounts? I'm wondering if one day the government might tax Roth withdrawals.
Well, I mean, I don't know if you guys are listening to the news, but in the news, Trump is talking about eliminating the taxability on Social Security and tips and overtime. These people that run our government play games with the tax system all the time. I am one that believes that if you have a very great pension plan provided for you by your employer, such as a state employee, maybe in that case a Roth would do you good. But for me, I believe you're alive now. You know what the tax code is now. And in the future, you don't know that will be tax-free. That's number one. But number two, the standard deduction keeps getting bigger and bigger and bigger, especially under the Trump regime.
Changes from
right.
2017.
It keeps getting bigger and bigger. Right now, it's $33,000 for a married couple, both over 65. You can start taking money out, tens of thousands of dollars out of your traditional IRA that you took the tax credit, got the tax deduction on, and it's not going to be taxable anyway. So unless you have a big pension plan that you know you're going to get in the future, if anybody does, number one. Number two, how do you know the tax code's going to be the same? Number three, how do you know you're going to be here?
Right, right. And I know what was the infrastructure bill a couple years ago, in the subsections was they were gonna tax Roths.
Right. And they, believe me, if the right people get in and they're looking for money, they may start hanging it on somebody that makes a lot of money, maybe $1 million or more, but they can open that door and change the law anytime they want. So all I know is from being around, I can remember when Social Security was tax-free. Then it could be, now it can be up to 85% taxable. So you're really putting a lot of stock in something that you might never have to pay taxes on, that you may not even be here on, that they may not even allow you to do in the future, so that you can give up the deduction out so that you don't have to pay taxes when you're older. And it may be with the standard deduction, you're not going to pay taxes anyway.
Right. But even to say, if the tax laws stay exactly the same for the next 30 years, right?
Okay, that would be interesting.
Right. But you're working, you're making money, the average person, okay? So they're paying, we'll say, 24%. But when they retire, they get Social Security and their 401k. Not a pension, but a 401k. So their income, what happens? It drops. So they go from the 24% bracket to the 12%. So you're thinking, I'm going to win. I'm not going to pay tax later. Well, okay, you're paying tax at 24% right now to avoid paying 12% later.
Right.
So who's winning?
Well, I think everybody gets it. I just have no faith in the fact that, I mean, I believe in saving for retirement, but the other fact is you have to contribute enough to your IRA, 401k to even make it so that when you annuitize it, that it's a lot of money. So yes, it would be taxable, but look at all the money you saved all these years. And with the standard deduction, for most people, they won't have to pay taxes.
Exactly.
Okay, we got something else here too.
Yeah, we got a text. I closed out both my son's 529 plans and had a check sent in my name. Both sons were paying on loans this year, and we are helping. Are there any tax implications on closing out 529s with the checks being sent to me? I know that federal allows you to use a 529 to pay student loans, but not the state. So yeah, you're allowed to take 10,000 out per child to pay on student loans.
And we don't know
So
how
we
much
don't
he
know
took
how
out.
much. We don't know.
But remember, the state of New York is where it was deductible, and that would be where it would be taxable if you don't comply with the rules of withdrawal, and you're using it for non-educational expenses. On the federal government, if you're using it for non-educational expenses, then the appreciation would be taxable. So because there was no benefit when you put the 529 in, only on the state of New York. So when you withdraw it, it becomes taxable to the state, and the growth would be taxable to the federal. So if you give us the amounts, we'll be able to help you.
Yeah,
Right.
give us a call at the office.
All right. I'm Esther Gilius, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. We're going to take a short break. We'll be back on the other side. Hey, to us, your family. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. We got somebody that was maybe not listening, or maybe they did listen. We got a text here.
Yep,
right?
it says, Esther, if we're paying some college tuition, I was told there's credits or questions we make under we make under 100,000. Married filing joint.
Okay, so you would be, if it's the first 4 years of higher education, and the kids could be going to a trade school, they could be going to a college, they can be going to cosmetology school, anything that's credited by the federal government, then the tuition that's paid or borrowed, okay? In other words, not scholarship, but this would be tuition paid or borrowed. It can be paid by the child. It can be paid by you. And the credit this is actual money. It's what percentage of the first 1,000?
It's a dollar for dollar credit of the first 2,000.
So they get 2,000.
And then it's a 25% credit of the next 2,000.
So that's 500.
Right.
So the credit is up to $2,500 on the federal for the first 4 years of continuing education. Then over and above that, in year 5, let's say it's a kid that's going to medical school, and you're paying for their tuition and they're still not making any money, then they would qualify for the
Lifetime learning credit.
Lifetime learning credit, which would be 20% of the first $10,000 or $2,000. And the state of New York, there's also an education credit that can save you, or itemized deduction, whichever does you better, which again is around $400. So you're looking at $2,900 to $3,000 in savings. That's a lot of money.
Yes, it is.
Right? Should be make mom and dad very happy. All right, so I'm going to ask you a question, hypothetical, Chris. You have $300,000 in your 401k plan. You have $75,000 in credit cards, and they're driving you crazy. You can't sleep at night, so you want to take the money out of your $300,000 IRA, a 401k. Should you do it?
No,
Why not?
because that 70,000 is going to cost you roughly on the federal and the state, depending on all your other income. That's going to cost you about
$30,000.
Yeah.
Right? Okay, so what's the way around it? There is a way around it,
Well,
isn't there?
instead of taking a distribution from your 401k, how about taking a loan from
That-
your 401k?
Absolutely. So you can borrow the money from your own 401k plan and pay yourself back over a 5-year period. So the money's all still there, and you don't have to pay $30,000 in taxes.
Right?
Right?
So it's a win-win.
Right. Before you do it, before you go and take money out of your pension plan, give us a call, because EG Tax would love to help you.
Exactly. Yep.
All right, let's go to Marianne. Hi, Marianne.
Hi, how are you today?
Good. How are you?
Good, thank you. I was listening, but I missed part of it about property tax. If you're over a certain age and if you're making under a certain amount, that you would be eligible for some kind of a credit.
Well, your age doesn't really have anything to do with it, does it, Chris?
Not the old 229.
Right.
No.
So the IT 229, which is now not in the law anymore for New York State, but is still available on 2021, 2022, and 2023, if you missed it, would be for people that are paying property taxes that exceed what's
About
the percentage?
6%
Yeah,
of your
AGI,
income.
right?
Yep.
6%.
So how much is your income, Marianne, approximately?
Oh shoot. I just looked it up. Here, I have it right here. Sorry.
I mean, just off the top, we're not doing a tax return right now.
Right,
just
right.
off the top of your head, what's your
My
taxable income?
My taxable income is okay. I know. Aren't I terrible? I like to be exact.
But that's okay. We're just doing a radio show here.
Okay. My taxable income is, I don't know. Okay. Aren't I terrible?
Marianne, do you have a pension?
Yes, I have it right here now. About $24,000.
That's
okay. So, and the 12, 14. Okay. So, how much are your property taxes?
Okay, my property taxes.
Oh, you're going to look again. Do you have any idea off the top of your head?
My property taxes are about $3,000.
I don't think she makes it.
Well, on 24, but
she'd be 14.4.
14.4 times 6% would be
no 24 times 6 is 14.4. 60%.
1,440.
Yeah, right.
So so 3,000 over 1440. Yeah, there's more math. We'd have to.
I don't think you're going to qualify because it has to fall between 250 and 350. So I don't think you'll make it, Marianne. But if you want to
go visit our Grand Island office,
just go to Grand Island and they'll figure it out for you.
Okay, I should do that rather than go to the county to Grand Island hall because
the Grand Island City Hall won't help you with the credit. They'll say go see a tax person.
Just go to EG Tax on Grand Island.
Okay. Oh, yeah, I know where that is.
All right, Marianne.
All right, very good. Thank you so much for your help.
All right, bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone.
But, speaking of property taxes, I'm so amazed how many people are not registered for STAR. I mean, just go online, register, and you could save $400 a year on your school tax.
Whenever they leave it for you, like they'll say, and apply the discount code. If it's left to the person, many times they just don't do those things, right?
Yep.
All right. So, wanted to also we were talking about the person that has $75,000 in credit cards and they're losing their mind. The other thing they could do is rather than taking the money out of the 401k plan is maybe borrow from a family member, right?
Yeah.
Or go to debt counseling.
Yep.
So that they can get rid of the credit card expenses. So, I mean, and then last but not least, bankruptcy's there for people that need a fresh start. So that's another thing you can do. The other thing is if you got kids in daycare, if you use and you have a cafeteria plan at your company, we were just talking about daycare is only deductible up to $3,000, except when, Chris?
Well, you can use your FSA, your flexible spending account, and you can put into $5,000 pre-tax, which not only saves you federal and state income tax, it also saves you Social Security and Medicare tax on that $5,000 as well. So that could save you 7.65 plus 22, that's so 30 plus New York State, 35% on $5,000.
So it's a great deal.
It's a great deal.
But the whole thing is, if you use a flexible spending account, you must use it. Because if you don't use it, you lose it and it becomes taxable.
Right. But with the costs nowadays of daycare,
I know that's for sure. That's something I'm really hoping they're going to address during this Congress. The other thing is, if you're somebody that has capital gains and you've had the stock for 8 months, capital asset for 8 months, and you got a big gain and you're tempted to sell it, why should you not sell it right away?
well, because of the short term counts as ordinary income. And if you held it for more than a year, you pay long-term capital gains rates, which could be 0, 15%, or 20%,
Right.
depending on
And
your...
so if you're under the 12% tax bracket, you pay 0%. So waiting that extra period of time can save you a lot of money,
Yeah.
right?
Yeah, you're going to gamble on the stock, but, you know, you got to look at it, especially if you're very close, I'd wait and see.
All right. And the other thing is, let's say you have money in a bank at 4% and you think, boy, that's great. But do you know that if you move your money from a bank to the market and you got some blue chip stock that is paying the same yield as your interest in your bank account, then that becomes dividends, and dividends again have that lower tax rate. So rather than being taxed at ordinary income, it's taxed as a capital asset, and so you pay less.
Yep.
So another way around it. Okay, so this week, while you're getting everything together, make sure you don't rush out to do your tax return before you have everything. You want to make sure that you do a complete and accurate return. If you've been on unemployment, you have to find out what your unemployment is and the withholding before you file your return. Otherwise, you're just going to gum up the works. If you're getting letters, because we never know when they're going to send out a letter verifying identity, that has to be done. They're going to hold up your refund without you proving your identity. If you need help with that, you can give EG Tax a call because they'll hold up the refund pending your verification of your identity. So this is their way of helping to stop the fraud,
Yep.
right? Okay, well, until next week, I'm Esther Gilius, the tax lady, with Christopher Fabian and Tiffany, who was just kind of on the phone with us. And we hope you have a great week. Thanks for listening. Thanks for your questions. Go to egtax.com. Go to any of our offices. Ask the tax lady. Thanks for listening.